Okay, Doug. Uh,
Hello.
hey, how's it going?
Great.
So we're sitting down here again at our conference table here. We had a topic for today: do's and don'ts of getting approved for a mortgage, which we deal with a lot. In for anybody out there who's thinking about buying a home, a lot of times they think, well, how am I even going to get approved for a mortgage, and what do I need to do with my finances? What if I have some stuff in my past, or I don't know, lots of different things I think people think about. Should I buy? What
Sure.
about buying a boat, or what kind of house can I afford, and all that kind of
Okay.
stuff. So,
Yep.
and you have a background. A lot of people maybe who are even watching this video don't know you have a background in
Mm-hmm.
mortgage.
Yep.
You were in the mortgage industry for how long?
20 years.
20 years.
Yep.
And you owned a mortgage company, and
Yeah.
and then you were a loan officer for quite a few years, right?
Yeah. So let's talk about um, some of the things that you should be thinking about when you want to buy a home, and not only where you want to live and what type of house and how expensive of a house you want to live in, but you should also be concerned about how you're going to finance the house. So
Yeah. So Doug, if I came to you and I said, Doug, I want to buy a house. What do I need to know here? What are the top 5 or 7 things that I need to know ahead of time?
yeah. Well, let's go to a perfect world. The perfect world is you have really good credit, you have really good income, very low debts, and you're ready to buy a home. So pretty much, if you're in that situation, we could skip forward and tell you what to do and not to do during the mortgage application process. But let's just start back up a little bit before that. Um, Preferably a year before you want to buy your house, you should check your credit. Make sure your credit is good. There isn't anything strange on your credit that you don't know about, and if it is, get it off of there. If it's something that you can't get off, it's because it's something that really did happen. Go to a special company a company that specializes in credit repair, credit to increase your credit score. The credit score is what mortgage companies look at to determine if you're qualified for a mortgage, for repayment of the mortgage, and also determines what interest rate level you'll be at. Because if you have a really low rate, if you have a really low credit score, you're going to get a higher rate.
So what's a good credit score?
A good credit score is 700 and above.
Okay. And what's a bad
I think
credit
the
score?
maximum goes up to 900 or somewhere in the 800. So
What's a bad credit score?
I think FHA is the lowest type of mortgage you can get that allows the lowest type of credit score. I think that's right around 600.
Okay.
And so you'd want to double check, with a mortgage company to say, hey, I've got a credit score of this. What, is this a problem? Is it going to help me, hurt me?
Okay.
Okay, so now, now also you're trying to get rid of any excess of debt that you might have. Credit cards, boat payments, car payments, try to get rid of those as much as possible. Because how they qualify you is they take we call it a debt to income ratio. So they take all of your debt, add it all up, and divide it by your income, and that's how you're going to get qualified.
You mean like your monthly debt
Monthly
obligations?
debt obligations are the only obligations that they consider are your long-term debts, things that are longer than let's say 6 months. So student loans, boat loans, car loans, anything like that, child support payments, anything like that, that's longer than 6 months.
And then they take, for income, they're really basing that on your proof of your last 2 years of returns, or
Right.
plus your most recent.
Well, no, they're just going to take your most recent current pay, and where some people get into problems is they're thinking they can use their overtime, and you can't use overtime unless have been getting it consistently for 2 years, and then they average it for 2 years. And so if you're just thinking, well, I'll go and apply for a mortgage when it's the busy season at my work, and I've got the highest overtime during that period, they're going to use that? No, they're going to average it for 2 years. And about 50% of the underwriters for mortgages are asking the employer to sign a statement that you're going to continue getting the
Overtime?
the overtime for the foreseeable future. And so if you've got a really nice boss that'll be willing to sign a letter like that, that'll help.
What about with bonuses? A lot of people get
bonuses, again, same as overtime, consistently over the last 2 years. They'll average it, and then again, the employer has to sign that you're going to get a bonus for the foreseeable future.
like I have a friend who gets a big bonus.
Yep.
Really, it's kind of an expected part of the pay.
Yeah.
But that went down a lot last year.
Sure.
So
they're
that
gonna
would
average it out.
that would affect it for this year
Yeah.
and what even the employer would write on a letter.
And if you're self-employed, that's a whole nother area.
Mm-hmm.
They're going to average your income for the last 2 years.
Mm-hmm.
They're going to ask you for your current balance sheet, your current profit and loss statement, and they're going to look at a trend. If you earned a lot of money 2 years ago and then it went down last year and now this year, they're going to look at it as a trend going down, and they're going to reflect that and not give you as much income as you might had hoped. So for self-employed people, that's a whole nother issue, but you have to be careful about that also. Now, let's say you've done all your homework, you've done your planning ahead, and now we've applied for the mortgage. We get a pre-approval letter, which is great. Even better than a pre-approval letter is what we call a borrower's financial statement. Talk to your loan officer about that. That's even better than a pre-approval.
Okay.
The reason being is they do more research on you, and it's a more solid statement from the lender that they really can give you the loan. More solid statement you get from your lender, the better the seller that you have to give that letter to will look on that letter. And if you're in competition with somebody else on buying a house, hopefully they would look at your letter more than they would the other guy's letter. It isn't as good as yours. So you want to get as good a letter from your lender as you can to remove all the question marks that you will be able to show at closing with the money to buy the house. So now the problem that we've been encountering is people think, oh, I'm approved for my loan, I'm going to go buy my house, and now I'm going to go buy my refrigerator that I always wanted for my new house, and I want to buy, I'll probably need a snowmobile to race around and whatever else. And all of a sudden, we come a week before closing, and the mortgage company pulls a credit report again. Just before closing.
Right before closing.
Oh, my goodness. He's got $150 a month new debt that we didn't have before. That goes against your ratio, and your ratio, now you don't qualify. That's not fun. Same thing like jobs. Do not change jobs during this period. They do call your employer the day of or the day before closing to make sure you're still working there. If you're not working there anymore, no loan.
Right.
It doesn't matter.
So you're just overall, you just don't want any changes in your debt or your income unless it's a positive thing.
Unless it's a positive thing. Well, some people say, hey, I'm getting a new job. That's positive. I'm getting more pay. That's not good, because you can't get a loan from based on your new income unless you've been working there. Some underwriters want at least 2 paychecks. So if you're getting paid every other week, that's a month. So you can't buy your house.
So you have to, hopefully the seller would wait around a couple months.
Hopefully the seller would wait for you, but that's not a good situation. So don't do anything unless you check with somebody first. And my recommendation is check with your real estate agent before you check with the lender. Because technically...
And when you say lender, a lot of people don't know that.
Loan officer.
Some people, they're not clear. The loan officer, mortgage officer...
Technically, anything you tell the loan officer has to go to the underwriter. Okay?
Right, that's the law.
Yeah. And he's supposed to transfer that information because he's not working for you. He's working for the mortgage company. So anything he knows about you, he or she is supposed to transfer over to the underwriters. So it's better to check with your real estate agent first so they can counsel you on what to do, what not to do.
Yeah, that's huge.
There you go. Okay. And I think that's about it. Just be careful. Mainly, the moral of the story is once you get pre-approved for the mortgage, you've done your homework before you've done that, so you can get pre-approved with no problem. And now you are ready. You found the house and you're ready to close. You're waiting to close. Just don't do anything out of the ordinary regarding credit or income or jobs or anything like that unless you've gotten an okay from the real estate agent. Probably first. Bounce off your ideas from them first. So.
Okay. Thanks, Doug.
Good luck.
Appreciate it.
Go buy a house.